Hello, good morning.
Good morning.
Okay, shall we start?
Good morning, sir.
Okay, right.
Yes, sir.
Today, sorry for the little delay because I am not operating today from my, I had to operate from my office because there some work to be done and I'm in the office. Sometime there may be certain disturbances, telephone calls and other things I may come. So bear with me for a short while, okay? Right. Today we are going to discuss about the continuation of last week's session. We discussed last week the principles of lending, fundamentals, what are things to be looked into lending, the basic things in lending about policies, now we are talking about the guidelines and how the guidelines are formulated by the banks and all the institutions. Before that, we'll just find out, just to see, understand the customer needs. Because normally, any customer comes with his needs. That needs are financial needs. So we are financial service providers. All the lenders are financial service providers. So we provide financial services to customers, the needy customers. There are two ways. Sometimes the customer comes and asks for a facility from us. He tells his need. There are certain instances we try to find out the customer and market our products, create a need and market a product. So today's concept, second is important. Create a need. We have to find out people, entrepreneurs, and discuss with the schemes, look for his potentials, and create a need for give our lending product. So businesses need finance for variety of different purposes, but there are some common reasons why businesses apply for funding. Reasons can be include business grants and loans for working capital. So on if any ongoing business or new business, one component is the working capital. There are very important part is the working capital. But without working capital, no business can run because that is a lifeblood of a business which is revolving up to create, generate income and the profit. Then second is to buy machinery. This machinery is capital expenditure. It's a capital expenditure. Okay. So the buy machinery and to hire more staff. Now this is another area of working capital. We call this working capital revolving working capital. Staff salaries and uh, purchases of raw material ongoing basis. There are certain expenses are incurred. That is also part of working capital. That working capital we call as revolving working capital or operational working capital. Or even refinance existing loans to reduce monthly cost. There are the very rarely you get this type this here in Sri Lanka. Only in the case of default only we do this part. That means if a customer comes and tells that he want to reduce his loan installment monthly because he is having some problem, he have paid a certain amount of finance. Certain part of the loan he have already paid. So we can refinance exit facility. That means, for example, if you take a 1 million loan, after 3 years, after paying for 3 years, now he comes may ask come for a, and ask to refinance or reschedule that the loan facility. That means lesser amount for a little longer period, thereby reducing the his installment. So this is another item where businesses seeking funds. So most common reasons that businesses apply finance is the working capital, very important part. Most important part is working capital. So working capital, there are two components I told. Permanent working capital, that is purchase of machinery and equipment, and vehicles are permanent working capital. Then the other one is revolving working capital, day-to-day operations, purchasing of raw material, meeting of expenses, day-to-day expenses. If it's a manufacturing organization, the process work in progress, we call WIP, work in process, are called working capital. Then purchase of assets can be a fixed asset, long-term fixed assets, that would buildings with land, infrastructure development, or else machineries, vehicles, furniture and fittings, which are needed for the business, are assets. Then starting a business, initial capital. Sometimes certain businesses, specifically the small entrepreneur development programs. We do that now, developing new entrepreneurs, school leavers. They don't have a starting capital. So can support if the project is viable, can do it. Then the starting capital, we may pump, starting the business. Then growth funding. Growth funding means after establishing a business, right? Business is expanding. To expand the business, we may funding. We are giving customer may also finance, expand new machinery, new building, opening new branches. Those are growth funding. And finally comes the debt restructuring. That means if a customer defaulted for some reason, that reason is acceptable and the reason is justifiable, the reason for the default is uncontrollable, but after restructuring, he may able to carry on the business because business is viable. Therefore, we may do restructuring. So debt restructuring also, sometimes you need further finance, right? Now this is point of view from the customer point of view. This question asking for the customer. How to know when you will have a cash gap? That is a need. Are you looking to focus when you might need to apply for a business funding? Right? Focus why if his capital is not sufficient, he had to borrow from outside. What type of funding he is looking for? So that gap can be identified through a cash flow forecasting. So this is one of the technique we use to identify the credit needs of a customer, business customer. Check out float cash flow forecasting for easy to use. Always up-to-date software that keeps your cash flow forecast updated automatically with what's really going on in your business. So this will to a customer, if there are certain packages, software packages can establish in the business, so he may see when the on the flow of the business when the cash is getting short. In other words, cash is not sufficient to pay his day-to-day bills. So this we call a deficit, cash flow deficit. There are certain periods cash flow surplus. There are certain periods cash flow deficit. So when the cash flow deficit comes, that deficit has to be matched or bridged either by the customer's own funds or by bank loan. So that is where we look for credit as a credit need. And when you work out this cash flow projection forecasting, we can identify how long this gap is there, shorter, longer period. Depending on that, we can structure a customer a facility according to the customer need. Now this concept is one of the fundamental we call as cash flow based lending. Cash flow based lending. Lending based on the cash flow. Using scenario planning, you can plan for the month ahead and see cash gaps before they happen. So this the customer. We also can do the same thing because we know that we have certain difficulties in the banks when you're working to grant a facility for a customer. One of the major problems we are having is our delegate authority levels. Our delegate authority levels. Sometimes it's not sufficient to meet the customer need. So we have to send our proposal to higher management. So therefore, it is very important to plan it out by the customer and the banker that his future needs, his future cash needs. So the cash flow projection, one of the tools we can identify the future cash needs of the customer and plan out in advance till not wait till last minute the customer comes and asks. We can arrange a facility and keep it ready whenever customer comes. They can forward it. So we can avoid a lot of unnecessary problems. So this is the modern banking concepts, right? Identify the customer need in advance, and we get ready without waiting till the customer comes and asks for it, right? In the current climate, most businesses are seeking out different means of funding. There are different types of funding. We know what are the types of funding. Last week we discussed this one: equity capital, customers capital, loan capital, then the customer deposits, repayment of loans, and retained profits. These are the sources of funds, funding sources. Depending on the requirement and the availability, customer may decide what type of fund he needed. So if you select the external funds, that's the bank fund will come. Right. But in order to understand whether or not your business may need funding due to the COVID-19 outbreak, you need a reliable cash flow forecast. So the current climates, we find this. COVID-19 problems, lockdown, businesses have certain, what you call, limitations, control of the businesses. Therefore, how much credit need, the reliable cash forecast is very important. You can fund expansion with it to be your premises, workforce, stock levels, vehicle fleet, or more. This is an expansion, or we call growth need. Business can be growth, that need is there. You can keep your businesses solvent when customers are late in paying their invoices during a seasonal, dry patches, or through any other unexpected quiet period. Businesses, if you find there's no what you call even or equal sales, right? The businesses, there are ups and downs. Certain seasons are there, heavy business during season time. Off season, sales are coming down, income is coming down. So they know we are not going to invest in those periods because we know that he may not be able to pay. So therefore, I identify the business cycles, seasons, right? And whenever seasons arranging customer to buy more stocks, his more sometimes some businesses you may find that temporary employees are they are recruiting temporary, so there are high costs involved. So that time the credit is needed. You can afford the equipment, stock, premises, or people required to take a business to next level. Most of the time, businesses should manage the expansion within their existing limits. Right? That means if the expansion needed for equipment, of course they go for external funds. But most the premises can go for external funds. But the improvement of business more not needed a credit facility. They should be able to manage with the business cycle. This is very important part of the we have to study when doing credit. The what we call cash flow cycle. How often stocks are converted into cash? Stocks are sold and converted into cash. There's a time lag. Now this time lag has to be financed either by the customer or by the bank. Right? If you finance once, that will be revolving. Stocks are sold, cash are coming, again buying stocks, sold, cash coming. This is called cycle, operational cycle or working capital cycle. So the cycle is moving smoothly every end of every cycle, right? With the sales, the stocks realizes with the sales, element of profit also comes in. So if the business is investing the profit back to the business, so business is expanding, no need any other external funds. Within internally they can generate funds. As well as this tangible benefit, borrowing with the right lender also gives you the peace of mind. For example, you have a fixed interest rate, quick funding decisions, and dedicated account managers with the years of relevant experience. Experienced bankers, right? That is other things which we have to look into in the customer comes. Customer looking for that, and we have to get ready with that information. And interest rates, quick decision making, and dedicated account managers are important. So bank loan activities, therefore, you can see the loan is going to fall on the customer's head. What do you mean by that? There's a risk involved in the lending activities. There's a risk. What is the risk? Any moment it can be defaulted. When you defaulted, the bank may get collapsed. So this is a risk. On the other hand, you can see there's an asset, right? And just try to balance it. He says there's an imbalance. You can see there's an imbalance. The percentage of interest and the lending has imbalance. Because the interest is high, capital is low. That type of there should be a balance. So the amount of facility, the interest rate, should be able to manage with the customer. That is important. What we have to look into, whether the customer can manage it. So therefore, a little about the risk factor. What is the risk? We call credit risk. But we are not talking all the risk factors in the banking industry. This is one of the risks. Major risk is the credit risk. Credit risk analysis can be thought of as an extension of the credit allocation process. Right? Any credit facility, any credit proposal comes to us, we have to analyze the risk factor. A number of external risk, internal risk, market risk, customers risk is there, life risk, then the technical risk, right? The credit risk, the strategic risk, likewise. There are a number of risk elements are there, bank has looked into. Basically, what we see is the credit risk. The credit risk is basic, in simple terms, is how best customer can repay the loan. If the repayment source is established, our risk is mitigated. Okay, so always evaluate the quantum of risk by any given time is the outstanding balance. Any given time is the outstanding balance. Credit risk analysis can be taught us as an extension of the credit allocation process. After an individual or business applies to a bank or financial institution for a loan, the bank or financial institution analyzes the potential benefits and costs associated with the loan. We know what we do is we analyze the cost and the benefit. If the costs are greater than the benefit, we are not going to grant that facility. Okay, that is the risk. The credit risk or credit default risk is the type of kind risk faced by lenders. Credit risk arises because our debtor can always renege on their debt payment. He may face sometimes problem during the course of the time. So we cannot clearly say any facility is without a risk because we are granting a facility to recover in an unknown, uncertain future. Credit is going to recover unknown, uncertain future. Therefore, in the unknown, uncertain future, there's a risk. Anything can happen. Right. In the lead up to 2008 Great Recession, commercial banks, investment bank, and other financial markets participants underestimated both the default probability and the loss rate was consequently underestimated, and the credit risk they were facing. In 2008 recession, we also faced this difficult sometime, up to a certain extent. Right? World recession, and some banks have been unable to continue. In 2008 recession, if you, according to the reports, 3,896 banks were closed worldwide. Luckily, in Sri Lanka, we didn't have such a problem because of our controlling measures by the central bank. Okay, so always the credit risk is had to see short term as long term. Most of the instances we have tried to see far away, but we don't see what is in the close by. The risk in the close by can't see because we are looking from far away. But there's a risk on your doorstep. Now you can see this iceberg. The tip of the iceberg is very small, right? It's floating on the water. But underneath, the size of the iceberg is very large. Till it knocks in the iceberg, the ship, you can't see it. So this is a risk, right? To avoid the risk, now some there are certain conditions put across by the organized banks, right? Now this is one of the board thing. Credit will only be given to people over 85 years of age, provided accompanied by both parents. What do you mean by that? This bank is never gives loans, right? Over 85 years, very limited customers, and also provided accompanied by both parents. By that time, parents may not be living. The parents should be more than 100 years. So you can avoid giving credit. Without telling we are not providing credit, but it's business credit sales. So they are business credit sales, right? They are not selling for credit. And without telling that no credit sales, put this type of condition. Okay, right. Let us see what are the lending guidelines. So part of this guidelines we discussed last week also. Certain policies and cultures are part of the guidelines we discussed last week. Anyway, lending guidelines are specific to lending institution and can be based on the maximum and minimum loan offers extended by a lender, associated fees, late payment penalties, schedules, interest rates payable, and amount of loan based on the collateral. So lending guidelines are given to the operational people, that's down the line by the management, top management, prepare this guideline and given to the rollout to the branches, that is operating units. Operating units only rolling out the lending part, identify the customers, right? And what type of product, all this has to be decided. Lenders work under government financial regulatory bodies, which provide various regulatory guidelines to guide the operation of the institution. Right? So, no bank or financial institutions are running by their own. There are certain regulatory guidelines issued by the what you call regulator. In Sri Lanka, the regulator is the Central Bank of Sri Lanka. The regulator is the Central Bank of Sri Lanka. All financial institutions, banks, specialized banks, finance companies, leasing companies, insurance companies, then money market, all financial operational bodies are governed by, controlled by, managed by central bank. So central bank has its certain guidelines. These guidelines are coming in the for the banks are coming the guidelines we call as directives. Right? The directives given by central bank. So the central bank legally empowered to issue these guidelines under Section 46 of the Banking Act number 30 of 1988, as well as Section 76, and also provision made in the Finance Act 1950. Yet central bank has been established. Empowered to control, manage the lending. Time to time, directives are issued by central bank, and those are coming like guidelines comes to the bank, to the head office, through the head office, it comes down the line for the branches. So we will see certain guidelines, for example, nowadays, the limitation of granting facilities, right? There are certain instances where the what do you call inflation is very high. Central bank will reduce the lending. So they have different method of doing it, directly controlling or indirectly controlling. Directly controlling means advice not to grant facilities for this. Now, for example, in the current environment, banks are restricted to grant facilities for certain products. There are a list of products gazetted by the government. The directives given. You can you lend, finance for you loans for these purposes. Similarly, sometimes the indirectly to reduce the giving credit, interest rate can be increased or reserve rates can be increased. Those are qualitative techniques. No, right? Quality has been changed, not the quantitative. So there are two types of guidelines are coming from the central bank. Also, every institution, however, follows its own internal guidelines in the line with the regulatory guidelines imposed by the government or its agencies. In addition to the guidelines given by the uh, central bank, it also comes to the head office, like internal guidelines. The internal guidelines also created by the banks. Now, for example, head office can issue guidelines how to select the customers. What are the criteria to select the customer for a segment of lending? Taking the case example, lending to a small, what do you call it, SME sector, entrepreneur development program. To identify, select the people, potential borrowers, there are certain guidelines are given by the internal credit policy committee, depending on their culture and the formulation. Right? So this is the age group. Now this qualification must be there. Or this qualification has to obtain from this particular area. And quantum of facility is this much. Maximum and minimum. This is the interest rate. So these guidelines are given to the bank to, they have directed the banks to go along with that. Okay? So banks are, the branches has to follow up these guidelines. Loan guidelines include eligibility rules. What are the eligibility criteria? Age, education qualification, technical knowledge, right? Then other legal requirements, those are eligibility rules. The type of loans to be provided, the loan package, a loan or overdraft or letter of guarantee, what type of facility to be provided, and the conditions. What are general conditions? Then, in analysis of a facility, you have to identify the specific conditions. Then the collateral. What type of collateral should be taken, and the procedures. Now, these things are coming as a guideline. Like in the, normally the guidelines comes as a circular. We call as a circular, not like as guidelines. Internal circulars are the guidelines. Internal circulars are the guidelines. Okay. Not everyone is eligible to loan unless they meet the lending criteria provided by the specific lending institution. Depending on the lending institution, right? Their lending criteria based on the uh, based on their policies and culture. Lending policies and culture, these guidelines are provided, right? So all the customers comes for asking for facilities will may not entertain for giving the facility. Sometimes these guidelines gives you the directions where that if the customer is not fulfill those requirements, we may refuse that facility. Okay. When conducting a loan analysis on a potential client, lending institutions analyze the financial statement of the client to determine their financial capability and their ability to honor the loan obligation without a strain. The financial statement of a business organization is the what do you call it, document shows the source of funds. That means the cash, the profits, and profits realize how much of surplus cash having to pay back the facility. What is their strength, assets? So there are a number of ratios we work out, a minimum of 12 ratios we work out to find out whether a business customers having the financial strength, financial capability to get a loan, to pay the loan obligations. What are the income pattern? How the income is coming? What are the outflows? And what is the surplus? Whether the surplus is sufficient to pay loan obligations without any difficulty. You may find sometimes some months customers cash flow is very high, so a certain period very low. So we have to look into that and adjust the loan installment accordingly. Like this is current thinking of guidelines. Lenders can offer their either long-term or short-term loans, either long-term loans or a short-term loans, and depending on need, the type of the need only normally decide what term loan should be given. For example, if you're doing a construction, building, infrastructure development, right? A long-term loan, where the repayment period is very long. That's called long-term, 5 to 10 years, right? Short-term loans, 1 to 3 years. Short-term loan, based on the customer's repayment ability and the need. Two things: need, repayment ability. The long-term loans are we are given for buildings, constructions, infrastructure development, such needs, 5 to 10 years. Short-term loans mostly we are given for another capital expenditure, machineries, motor vehicles, furniture fittings. Okay. There again, short-term, there are certain loans that comes with the shorter period. Long-term loans come with the longer repayment period, and borrowers are required to repay the loan within the period exceeding 1 year. Short-term loans offer shorter repayment duration than the long-term loans, and the borrowers should repay the loan with a few months or under 1 year. Now, these called, we discussed earlier, working capital finance. These loans are revolving. Purchase of raw materials, stocks, day-to-day expenses, work in progress. These are short-term duration. So the loans are given less than 1 year. More often, a revolving facility backed by a permanent overdraft. Okay. The lending guidelines are specific to lending institution and can be based on maximum and minimum. Back here. Sorry, we'll continue. What are lending guidelines? The lending guidelines, therefore, period wise, can be short term, medium term, or a long term. There are three specific types segments. Period wise, we decided the guidelines are given by the bank. Long term facilities for infrastructure development and construction. Medium term, 3 to 5 years for uh, machinery, equipments, furniture fittings, and vehicles, and the short-term loans for up to 1 year for working capital finance. So this call we call the structuring. So any proposal comes from the business customers, we have to identify the need and structure a facility according to the need. There may not be one loan. There can be several loan facilities with different repayment period and with the different securities. It's called structuring a facility according to the need, which can is one of the most important factor to avoid the non-performing. Right? Depending on the customer need, structure a facility to meet their needs. The lending guidelines are specific to lending institution and can be based on the maximum and minimum loan offers extended by the lender, associated fees, paid payment penalties, schedules, interest rate payable, and amount of loan based on the collateral provided. The loan is based on there are two components. One is the need, other one is the, the bank's policy of granting the facility guideline. Maximum amount and minimum amount is already defined. So beyond that, we cannot go. Okay, all the customer need is very high. We may not be able to entertain that type of customer beyond that limits. The guidelines also outline loan security measures and procedures laid out by the institution. What are the loan security, collateral, and how to when you to secure the facility, not only the collateral, the repayment source procedure also has to be given in the guidelines. The loan procedures may include disbursement steps, loan application guidelines, loan collection guidelines, loan supervision, approval and review procedures. How to disperse? Normally, what happened to now, most of the instances, very traditionally, when the credit facility is sanctioned, entire amount will be released to the customer's account on the very first day. It should not be the way. It has to be need-based finance. That means look at the need, how much needed, that amount to be released. And step by steps, what are the steps to be disperse the facilities. Now this normally happens in housing loans, state by state releases. But in the business loans also, it has to be the same way. For example, if a business started, the first component is the construction, release that. Second component is the purchasing of machinery and equipment, release funds for that part. And other necessary equipment, purchasing of raw material, issue that part. Likewise, step by, have to decide it. Then the loan application guideline, how to fill the loan application, what are the information you needed. Bank to bank, the need may be different. What are need the customer requirement different, and what information you need also different. Some organization asking large number of information. Loan application goes over 5, 6 pages. There are certain banks, loan application just one page. Okay? So there is limited number of information. That depending on your guideline policy, that you can decide. Then how to collection. repayment source. How monthly, quarterly, annually, once and for all, based on the cash flow, not equal amount, fluctuate the variable amount. That also part of the policy guidelines. Okay. This is supervision and follow-up after granting the facility. Very important. Right? What are the procedures to be done? How often you have to inspect the customer's premises? All these things should be there in the guidelines. Okay. Right. Now let us see, go for the our lending procedure. What are the types of advances we are having? And individually, one by one, we just discuss what are these advances. Basically, as advances we call asset products. It's in the appear because it's appearing in our balance sheet as asset. In the bank's balance sheet, all the loans are appearing as in the asset side. Therefore, we call asset product. Deposits are liabilities because it's payable for outsiders. Assets are receivable on the customers. Therefore, it is shown in the asset side of the balance sheet. There are three types of, we can categorize into three groups the types of advances: fund-based advances, asset-based advances, and fee-based advances. Right? What are fund-based advances? Fund-based advances where banks' funds are given to the customer. Funds means cash is given to the customer, and customer has to repay according to the schedule, or according to the agreement. Right? So what are these types? There are two types of fund-based products, basically loans and overdrafts. Loans and overdrafts where funds are released to the customer's account for customer to use. So in the fund-based finance, right, banks have a lot of problems because bank has to manage their liquidity. In fund-based lending, banks' funds are moving out, so bank may have difficulty sometimes managing their day-to-day need. Therefore, the quantum of fund-based advances, item by item base, has to be managed by the bank. So this is one of the functions of Assets and Liabilities Committee. Without bank is facing for crisis situation, must give the fine facilities. There are instances banks were fund where the banks could not meet day-to-day operational expenses, needs, and has to borrow at the higher rate than the amount you lend. Right? So these are the, therefore it is always fund-based. When you are structuring a facility, we are looking into whether without giving a fund-based product, whether we can give an alternative product. Okay. Customer may need come and may ask for a loan. So we can design a product to suit the customer's need. Right? The second one is asset-based product. Asset-based product is we are not giving funds, banks or finance institution not giving funds, but an asset given to the customer, right, to use for his purpose. So, right, so that also has to be repaid. Funds are not moving, but banks' funds are invested in an asset. The asset is given to the customer. The asset is owned by the lending institution. Third one is fee-based products. Fee-based products are where customer needs certain finance, but banks are not giving any funds. No, we are giving an asset. Instead of that, the banks may accept the liabilities of the third party on behalf of a customer for a fee. That's called fee-based products. Letters of guarantees, uh, letters of credit, documented credit, are some of these fee-based products. So let us discuss detail. What are fund-based products? Are fund-based lending where the bank cash flows out and affecting the liquidity of the bank. Right? And fee-based lending, indirect call also indirect advances, when the bank accepts the liability where the customer dishonored the contract entered with the beneficiary, bank will pay the pay. Indirect advances does not affect the cash flow of the bank. When claim lodged by the beneficiary on dishonoring the contract, the bank compelled to pay by creating a direct liability in terms of the guarantee. Okay, so fee-based products, we are not funding, but if the customer default, the contract between the customer and the third party or the beneficiary, any claim lodged by the beneficiary under the fee-based, bank has to accept that to pay whenever this challenge. Right? So there are certain requirements are there to do this fee-based products. Normally, indirect advisor is a current rate of guarantee, uh, uh, letter of credit or document of credit we call as in terms, letter of credit LCs are coming under fee-based lending. So the one important thing under fee is, right, whenever claim lodged under letter of credit or this was fee-based lending, bank has liable compelled to pay that without any other contract with the customer and the beneficiary. Right? Well, a good example for you now we have this is Chinese organic fertilizer case. Organized fertilizer case. So bank a guarantee is given by the bank by way of LC. If the LC is not honored by the government, right? The beneficiary, the sender of this fertilizer, had claimed, lodged a claim, and if the claim is not paid, bank was blacklisted, and later on, bank has to compel to pay that, some millions of rupees, millions of dollars. This is the even though there is no direct advances, in the case of a default, a direct advance can be created. The other one is asset-based lending. Asset-based lending where lending is to provide an asset to customer to be used for his business without investing funds in the asset. Right? So customer no need to, and we does not have a capital expenditure, but he may use an asset. Customer will pay a rental or deferred payment for using the asset. Well, so you know that the two types of ones are leasing and hire purchase finance are two types of these assets. Right. So lending products in a broad manner, if I analyze what are lending products available, there are three types of lending products we discussed: fund-based products, fee-based products, and asset-based products. Okay, because what space I put fee-based also on assets. Right. What are fund-based products? Loans and overdrafts. Right? Loans and overdrafts are fund-based products. Loans also can be classified according to the customer-wise, consumer lending, commercial lending, and developmental lending or project lending. Right? Loans can be categorized into three groups: consumer, commercial, and developmental lending. Consumer lending, well, I don't think I have to discuss about that. There are certain products, only housing loans and nothing, we'll discuss that later. Then commercial products are depending on the market size, right? Retail market, middle market, and corporate market, the loan size is different. Products are different, products are same, but the risk is high or low. Then comes to second one is the development development loans. We can categorize two groups, that's industries and agriculture. In industry, you get cottage industries, small type of lending comes to cottage industries. Then SMEs, small and medium enterprises, and macro level facilities are loans are given under industry. Similar agriculture also we have got two types, small SMEs and macro level. Fund-based products, other one is the overdrafts. There are three types of overdrafts we are talking about: permanent overdraft, temporary overdraft, and casual overdrafts. Right? Then fee-based products are letters of guarantees. Asset-based products are leasing and IBSL. So broadly, if you look at any organization, any lending organization, these are the types of advances available. Under this, you may have different name, what do you call, brand name or different products under these schemes, right? Right. First, see what is an overdraft. Overdraft is marking a limit of credit over a credit balance on the current account of a customer. To give an overdraft, there should be a current account. Only current account customers can be given overdraft. That means marking a limit over the credit balance. That means the bank is paying checks drawn by the customer, notwithstanding the fact that the funds are not sufficient to honor them. Right? That's called an overdraft. Overdrawing, drawing over the balance, called overdraft. There are three types of overdrafts we are talking about. First one is permanent overdraft, we call POD. Is to mark a limit of a credit with a prior arrangement. Prior arrangement means there should be an agreement with the bank in a specific amount is definite, at a specific interest rate, and payable on demand. Payable on demand and secured by a collateral, which can be utilized during the period and renewed periodically. So, the permanent overdraft facilities are normally given in two instances. One is the customer's loan installment is high greater, his income is not sufficient to pay. We may entertain a permanent overdraft where customer can service the interest and reduce the balance gradually. Or else a revolving facility, permanent facility for a working capital finance, that means the revolving facility can be revolving within the limit. That's called a permanent overdraft. So there are basically arrangements are it's an agreement coming under the contract. And specific amount is specific and interest rate is specific. The payable on demand, as and when required, only the OD is given. That means OD limit is marked. Customer can use the OD as and when required. So the period of used only, they have to pay the interest. Temporary overdraft is little different. Now this is very commonly misunderstood term. Temporary overdrafts also to mark a limit of credit with a prior agreement or a reading request of the customer for a comparatively shorter period of time. Right? Temporary overdraft is temporary. Temporary means for a shorter period, a limit is given. Within a limit, limit is marked. Right? With a customer's request. This temporary overdraft always given with a customer's request. So there are legal requirements are there. We have to fulfill that. Therefore, it should be written agreement or written request should be there from the customer to grant a temporary. Normally, temporary overdrafts are given based on the bank's uh, uh, policy guideline comes as the delegated authority. So the branch managers are given certain amount of living authority. Within that delegated authority, overdraft can be given. Also, period wise can be maximum 30 days. Some areas is can be 15 days. Some banks is 45 days. Some managers are given more powers. Great managers are given 60 days. Likewise, it's vary depending on the bank to bank and the authority levels. The other one is casual overdraft. Now, this is the most commonly misunderstood overdraft facility. Casual overdraft is a service of the bank for valuable customers to pay their checks in excess of the credit balance in the current account without request by him, without the customer's request. Solely bank discretion is facility is given. And most of the instances when the check is presented for payment, right? There's no funds. The manager decides whether to pay the check or not. That's called casual overdraft. There's no time bar for that. Immediately, it has to be paid back. This service provided purely on the discretion of the manager or the authorized officer, and it has to be paid back immediately. There's no time bar given for that. So don't misunderstand. Some some officers, even the managers are using this casual overdraft as TOTs. It's wrong. Casual overdraft is never period. Immediately on the following day it has to pay because this is on the discretion of the manager is given. This is not a demand or request for a customer. Right? What's a loan? Loan is defined as are granted to the customers of the bank, financial companies on an agreement. So there is a legal binding is there. It's called an agreement, where by an agreed specific amount is specified at a specific interest rate or floating rate to pay on installment, monthly, quarterly, or once and for all. And in agreed amount, the amount of installments decided, an agreed period, how long it is going to be decided, which has to be secured by a collateral by both parties. So called a loan. So loan, the important thing is whenever you grant a facility, loan is credited to customer's account on the day one. Customer is liable to, borrower is liable to pay the interest as agreed, whether he used the loan or not. That's the advantage in the overdraft. If you have used, as and when used only, he had to pay interest. And this is the difference between loan and the main difference between loan and overdraft. Okay, let's see what are the types of loans we discussed earlier, the schedule. Consumption loan, right? That is for first we call personal loans, consumer lending, consumption lending, different terminology used by different banks. Consumption means utilizing the loan proceeds where induced will not generate any income or cash flow. It will absorb for the purpose. Right? Also, consumption loans are given for personal loans are given for personal purposes. That purpose is when the loan is used for that purpose, loan is absorbed to that. It will not generate any income. So if it generate any income, it's a commercial loan. Okay, that's the difference. What are the personal loans? Consumer lending products are long-term facilities, housing loans, education loans, medium-term loans, consumer durables, right? Short-term loans, credit cards, owning are short-term loans for the consumer lending products, right? Was it? This is what we discussed earlier. That's right. So then the finance in the housing sector, one of the most very common or popular product in personal consumer lending is the housing loans. So what purpose giving these housing loans? To purchase a dwelling house, to purchase a buildable land, construction of a dwelling house in customers' own property, purchase of a condominium properties, apartment. So commercial financing comes to the construction for commercial purposes, warehouses, and other commercial constructions. Normally, housing loans are repayment period is 10 to 25 years, depending on the bank. Most of the commercial banks not going beyond 10 years, but there are certain banks are there, NSB, State Mortgage Bank, Housing Development Finance Corporation are giving the facilities up to 25 years, and depending on the company. And the housing loan is a long-term loan. To grant long-term loan, financial institutions have a long-term deposit base. Otherwise, the mismatch will lead to collapse of the organization. So long-term fund base, that's most of the banks are running behind a children's savings account. It's a long-term deposit base. Or else long-term lending product, buying a debenture issue or like that, collect funds for long-term use. It has to be matched. Okay. Regulation criteria 5Cs and Campari. What are 5Cs? Character, capacity, capital, condition, what we last week discussed. Therefore, I'm not touching on that. And there are other techniques also there. In, uh, if you look at the UK books, you find this character Campari. That's common in UK books. Character, ability, margin, purpose, amount, repayment, insurance. Insurance is security. In Sympatics, number of technical analysis tools are there. Okay. Next one is we are going to talk about the project lending. Uh, the project lending is the credit facility being processed based on the future flow of funds generated from the project. Future flow of funds generated from the project. So always when we are going for project lending, we have to work out the cash flow, future cash flow. If the future cash flow is sufficient or there's a surplus to pay back, then we call project is viable. So the project viability basically based on the cash flow. The project viability is a key to this type of lending. Normally, project lending we are not mostly not asking for collateral, but in normal time, in the size of the loan, maybe ask for a collateral to mitigate the risk, but it is not a must. Due to high risk in the nature of the project, establishing viability of the future flow of funds and high cost of finance, most of the instances, project lending is backed by a low cost fund from the external agencies and a refinance or credit guarantee scheme. Right? Mostly project lending, find this type of development called project lending or developmental lending are backed by a government supported fund scheme. Because the two factors are high risk. High risk because uh, the external risk factors are very high in project lending. Therefore, most of the banks are not willing to go for this type of lending. Also, other problem is uh, high cost, high risk, and high cost. Because if you use the bank funds, cost of funds are very high. So with that high cost of funds, projects develop the products manufactured by that organization entrepreneur may not be able to sell it. Therefore, low cost fund is needed in project financing. So these are covered by certain what you call lending products. We discuss later. So developer lending we can categorize in two groups. One is macro level, other one is micro level. Macro level, the BOI projects, and large industries and agricultural project comes under BOI project. as well as large estates and all comes under macro level. Micro level are cottage industries, amount less than 25,000. Normal banks are not involved in cottage industry type of financing. Or most of the NGOs are financing for this cottage industry. The banks are involved in SMEs, the agriculture industries. What is the cost of bank risk in the lending to agriculture sector? Right. Let's take little into deep. Okay. Now, if you look at central bank report prior to 2009, you may find that linked to the agriculture sector by all the banks, entire portfolio was less than 5%. Entire portfolio to the linked to the agriculture sector before 2009 was less than 5%. This is the priority sector of the government, country's priority sector. But the banks are not willing to grant facilities to the sector, except for state banks. What are the reasons? One is high financial cost of funds, in the market risk, natural hazards, and willful defaults. In 2009, sorry, 2010, in 2010, the government decided this is the priority sector of the country, agriculture, and the small and medium industries. Therefore, it made compulsory in 2010 lend to agriculture sector minimum of 10%. Hello, good morning. Oh, आपके कराने ट्रेनिंग भी कराई कराने टेक्निकल ट्रेनिंग. Oh, दहा टाइम इसी हाई असर. नहीं नहीं अभी कराने टेक्निकल ट्रेनिंग कराने. खबरान में वेबसाइट है. सॉरी एम्प्लॉय ब्यूरो की वेबसाइट अवेलेबल है. हमारे को ना कॉल कराने की. Sorry. So lend to the agriculture sector was less than 5%. So the government in 2010 made it compulsory lend to agriculture sector minimum of 10% of their portfolio. 2010. Therefore, all the banks now compelled to lend to the agriculture sector. In 2018 budget, again, lending to the agriculture sector was established. What are the priority sectors to lend according to 2018 budget? Agriculture sector 10%, small and medium entrepreneurs and tourism another 10%, women and youth 5% on the total portfolio. That is 25% from the total portfolio. These are the priority sectors identified. So let us see the risk in agriculture sector and how to mitigate the risk. First one is high financial cost. How to mitigate this risk is one. There are central bank, the guidelines given, a certain criteria, the mitigating instruments are given to the banks. Right? High finance cost, because the bank is used their own funds, finance cost is high. Therefore, the government has introduced refinance loan schemes. That means you grant a facility, right? You grant selected section, selected project, central bank giving the guidelines, you lend to that project, and you claim the amount lent from the central bank. Central bank will give a low cost finance depending on the project, 5, 6% or 8% at the interest. Right? So you have to repay the refinance loan and collect the loan installment from the customer. That's called refinance scheme. The second one is credit guarantee scheme. Credit guarantee scheme means we have highly vulnerable types of lending. The lending organizations, lending authority, what you call institution like ADB, JICA, World Bank, the funds are given. Those funds are used to this type of loans. They have loans to given as loans through central bank. And the credit guarantee is given. Well, the credit guarantee means if the customer defaulted for genuine reason, a certain percentage of the default amount will be borne by the central bank under the credit guarantee scheme. In the last government, they had what you call enterprise Sri Lanka loan schemes. There were 11 loan schemes. Out of that, two schemes were under credit guarantee scheme. Right? Therefore, if any default due to natural calamities or natural reasons, without default, a certain percent, 50% or 75% or 35%, 65%, based on the risk involvement, the central bank will pay the cost. So it will reduce the bank's loss against a default. Then the central bank introduced another scheme. This was in 2006, the interest subsidies. Interest subsidies mean bank can use their own funds to lend certain projects identified by the central bank, and you lend with your funds. They are so central bank not funding as refinance or credit guarantee. We had to use our own funds, and at a lower interest rate. Now, for example, if your cost of fund is 9%, you may have asked to give the loans at the rate of 5%. So different 4% will be reimbursed by the central bank as a subsidy. Okay, so the burden will not go to your cost of fund burden will not go to the customer, borrower, and part of the interest burden will be borne by the central bank. That's called interest subsidy scheme. The latest one is introduced in 2015, the negotiable warehouse receipt scheme. Now, central bank with the ADB funds and the RDB, right, put up certain warehouses in the country. The first one started in Anuradhapur, Delhi, where the warehouse has been rented out for the needy farmers to store their produces. And the store in the warehouse, and the warehouse is issuing a receipt about the commodities in the warehouse. That receipt is a negotiable instrument. So whenever the farmer who have been rented out the warehouse and kept their producers in the warehouse, a negotiable receipt has been given. That instrument, the receipt can be kept as a collateral and get a loan from the bank. Right? So there's another method. It's a very to mitigate the risk the central bank has introduced. So the high finance cost, there are four products already introduced. Right? Those are four cost products are refinance schemes, credit guarantee schemes, interest subsidies, and negotiable warehouse visit. Second risk is market risk. Market risk arises, right, when the harvesting takes place of the agriculture product. Harvesting comes in the one and the same time. Harvesting comes in the one and the same time. So what will happen? The price will, the selling price of the producers will come down. Sometimes you may find certain products, you have seen the newspapers and all. Sometimes the farmers could not sell even for their cost price. There are certain instances. To overcome this risk, market risk, to stabilize the market, the four types of risk mitigating instruments has been introduced by the central bank. First one is forward sales agreement. What is forward sales agreement? Forward sales agreements mean farmer, purchaser of the stuff, and the bag. It agreed for a council agreement. It's called tri-party agreement. In this agreement, the the buyer merchant agrees to buy the produce of the farmer at a rate, forward selling price. Still, agriculture not started yet. Before the agriculture starting, comes to agreement to sell the produce, entire produce, at a certain price, and that buyer will agree to buy. Normally, a company they will agree to buy that at that rate. If this agreement is complete, buyer and seller come to an agreement, bank will provide finance, right? And bank was becoming a part of that agreement. We call a tri-party agreement. When the manufacturers are there, the producers has to be sold to the purchaser at the agreed rate, despite of the price of the market. Whatever price in the market, not bothered. The agreed forward to sales price at sale. And the company will buy that sales and proceed will be given to the bank, recover the loan, balance will be given to the customer, the farmer. Now this forward sales agreement system central bank has introduced, very commonly used by certain uh, supermarkets. Cargill supermarket, Keels, right? John Keels Group, Keels, and Haley's, CIC. They are using this forward sales agreement system to purchase the producers from the farmers, where the bank is involved in giving credit. So to establish the market, stabilize the market, although there are fluctuations in the market will be stabilized. Second one is certified price scheme. Now this is one of the recent days we have observed to what extent the certified price scheme is successful in Sri Lanka in the current environment. Really, it is also one of the successful method. That means the government will make have a what do you call minimum selling price. Minimum selling price will be decided by the government, and the buyers has to buy at that price or above that. So it will be confirmed for the farmer the price. Now, for example, paddy's certified price was 50 rupees. So farmer said the given a price less than that he should not sell because that's a it is compelled the buyer to buy at that price. Okay. higher the amount, problem. Right? This is a certified price scheme. It is. So paddy and other producers, the certified prices Miller Sahate Economy introduced. The third one is buffer stock by government institutions. When the harvest is there, the government institution will buy the entire stock or buffer stock, the excess stock by the government organization, specifically paddy. Load, buy the paddy and off season when the prices are increasing, that paddy will be put into the market, right? So paddy marketing board, CWE, ARCFed, cooperative societies are the government institutions who are buying this. In addition to that, you may find now these large scale what do you call businessmen. They also have in their warehouses, large warehouses, they buy at a bulk and have it load it and will put it that paddy or rice into the market in the off season where the prices will started increasing. Today you can see that it's operating, the buffer stock is operating very successfully with the Aralia and Nipuna rice millers. Even the government, you remember the Essential Services Commissioner appointed by this present government want to put the army to buy this paddy and store it in the army warehouses. But it was successful because the farmers didn't sell at that price. Always this traders, paddy millers bought the paddy above the certified price. Okay, so these instruments are there, but today's environment, to what extent is operating successfully is a question. The other one is agricultural warehousing. I already told you in last session one. What is agricultural warehousing is at Upul the ADB funded and the RDB, Rural Regional Development Bank, I put up large warehouses. It has been rented out to the farmers to keep their stocks, excess producers, rice, millet, uh, corn, most of the grains, to keep there in the warehouse and put into the market when the prices are increasing. Right? But if they need any short-term funds, they can pledge the warehouse receipt in a bank and get a loan also. That facility is given. It is successfully operating at the moment two places, Puldenir in Anuradhapura and Mullaitivu. Right after that, I don't think this government has not seen any this type of things are coming up. This is all of the last government. This houses actually thing. The other one is I don't know whether you can remember Harsha Di Silva started a project at Namulla, Prabhashwara, with the Indian Agriculture Department's help, put up a cold room to store vegetables and fruits at Damulla. And that's what started, then the government failed. I don't know what happened to that project. Even that day, Harsha Di Silva was telling that Dr. Harsha that very pathetic, no one is interested, the buildings in getting wasted. So there's no policy in the government to continue this type of valuable projects. Only political names. Right. Next one is comes to natural hazards. Natural hazards mean weather climatic changes, weather conditions and climate changes. Also, one more thing is not included here is the pests and diseases. Natural hazards are certain pests. Certain pests are coming and destroying the produce. You can remember sometime when they have a sale of the Labua, destroying the uh, corn cultivation and the millet cultivation. And some time back, there was certain Pomitica kumingi, one of the insect was attacking the coconut trees. So the natural hazards. Then that's a pest and pests. Other one is the what do you call other diseases. Dili diseases. So today we may have seen with this ban of chemical use of chemicals. So the most of the producers are getting damaged. Harvesting is half 50%. So natural hazards. So the natural hazards are mitigated by agro insurance scheme with the climate changes, pests, and diseases. Anything happens to the crop, and if the crop is insured with the agro insurance, then insurance will look after that. IBSL, you have seen that about 40 million has been allocated to pay compensation to farmers by the government to the decision of banning chemical fertilizer. So that is to mitigate the risk. Next comes willful default. Actually, this is no more valid under Offences Agrarian Services Act. Early 2010, Agrarian Services Act was amended. And there was a clause saying that any person defaults a facility uh, assigning agricultural land, can be agricultural loan or any other loan, assigning an agricultural land is a criminal offence. It can be filed action at the magistrate courts, and that person can be sent to 3 years rigorous imprisonment. In the 2016 amendment, this has been taken out, so this is no more. This act is no more in actually valid at the moment. But can be willful defaults can be there. But there's no risk mitigating instrument at the moment to mitigate that. Tamata Pahabari. Okay, so let's see what is next. What is a refinance? Refinance is a line of credit available for reimbursement of already granted facility, which is granted and disbursed under a refinance scheme with the guidance of the donor agency. Now, for example, certain external agencies, ATP, Asian Development Bank, or JICA, Japanese industry one, then Norwegian aids are coming, World Bank funds are coming. Certain projects, it can be agriculture or it can be any other industry. Line of credit is coming. So that line of credit will be given the banks or what you call the selected financial institution by the central bank will select certain financial institution, maybe the bank and other financial institutions, to roll out this project, right? And selecting of borrowers, disbursement, everything, managing, controlling, everything that should be done by the bank or the institution, selected lending institution. After granting the facility has to be claimed from the central bank. Central bank will give a refinance loan to cover up that facility, the amount with a lower interest rate. So the bank has to charge low interest rate according to the refinance rate. Normally, banks are asked to give, for example, uh, at the rate of 5%. Example, loan has to be given at the rate of 5%. Central bank will give the refinance loan to the bank at the rate of 2%. There's a margin of 3% for the bank or the finance institution to cover up their operational cost. The important thing is here to understand the refinance loan scheme is refinance loan given to the lending institution has to be paid back according to the schedule. Right? There has to be a grace period. After the grace period, the refinance has to be paid back. Despite the fact that the customer pays or not. The other fact is whenever a customer pays the refinance loan, the entire amount should be deposited at the central bank. That funds cannot be used for any other business purposes by the lending institutions. So this is what you have to understand operating of refinance scheme. Credit guarantee scheme is proportionate of the defaulted facility will be borne by the funding agency according to the agreed formula. I told you earlier 35-65. That 65% borne by the lending institution, 35% by the lending agency. Highly vulnerable, highly risky type of project, this guarantee is available. Okay. When the private bus scheme was started in 1980, this credit guarantee scheme was there till it is established. That is 75% of the default was borne by the Asian Development Bank. Okay. Then interest subsidies means the government offering a lower rate below the market rate for selected specified sector and reimburse the difference of the interest rate I told you earlier also. For example, we get that one of the products at the moment is the NCRCS loan scheme. NCRCS. The new comprehensive rural credit scheme which is given for paddy and other crops, vegetable, the central bank offering a lower interest rate to give loans up minimum of half acre, maximum of 5 acres. Within that range, give the loans to the farmers to cultivate paddy and other crops. Interest rate is lower, and the difference 6% interest rate is given. The bank's cost of funds is 9%. So the balance 3% government will pay back to the banks under interest subsidy schemes. So the interest subsidy schemes are not only for the agriculture, even for industrial sector also, the interest subsidy schemes are being given. Also, some areas like some time back in 2008, 2006, the government decided to give credit facilities to the state sector, state employees, housing loans and vehicle loans. Right? In 2006, government decided to give vehicle loans and housing loans to the state sector, government employees. Interest rate was 8%, and the cost of fund was 11%. 3% was reimbursed by the government to the banks. to grant these facilities at the rate of 8%. So these are called inter-subsidiary schemes. So the sectors, industry sector, there are small and medium sector, and also large project like PUI we discussed earlier. Also comes in project financing. Right. Commercial lending. What is commercial lending? So last session also we discussed commercial, the analytical tools and analytical techniques of commercial lending. Now let's see what are the commercial lending, what are the products going for the commercial lending products. Financing for commercial sector is to improve an existing or new businesses and invest in anticipation of the generation of the profit. Financing of commercial sector is to improve an existing or a new business and invest in anticipating on the generation of the profit. Project lending based on the viability of the project. Commercial lending, an existing business or a new business. Generation of profit. Whether the business can generate profit. So future cash flow and the profit and loss account has to be prepared and find out that commercial lending is viable or not for commercial sector. Okay, let us see what are the sector. Commercial sector comprises of sole proprietors, individual businessmen, sole proprietors, partnerships, the limited liability companies. There are different limited liability companies under the Companies Act. One is private limited liability company. One person or 20 can start a business. And what is limited liability? Liability of the owners are limited to their share capital. Okay, the companies are liabilities. Okay, responsibility, the liabilities are limited to the share capital of the shareholders, owners. In other words, any default, any collapse or bankrupt occurs, their personal properties, personal assets, personal wealth of the shareholders or the directors are not liable for the liability of the company. Okay. There was this famous case recently, about 5 years back, regarding this limited liability companies to attach the liabilities. Okay. Then the public company, private companies, only one person can start the 2007 Amendment, Companies Act. The other one is public companies. Public companies mean where the shares can sold in public, outsiders. Private companies, shares cannot be sold outside, only within the known people privately. Public companies, where shares can be sold openly. There are two types of public companies: the quoted companies and unquoted companies. Quoted companies where shares, everything be share issues and selling, exchange, everything be managed by security exchange. Unquoted companies are not coming through the security exchange, but they can sell their shares publicly. Okay. So there's another company called Limited by Guarantee. Now, these companies are not uh, business-oriented companies where the directors are guaranteeing a certain amount as accepted liability, limited their liability to certain amount only. Right? There are so share issues. These companies have so share issues. By the guarantee is given by the directors to a certain amount. That's called limited by guarantee. For example, it guarantee A director is guaranteed only 100,000, right? Liabilities up to 100,000, he will guarantee. Likewise. So normally these type of businesses are there's no business, not profit-oriented organizations, mostly service-oriented and welfare type of societies where they have a limited what do you call, liability limited uh, activities. For example, Bankers Guarantee Limited. That is a company formed under guarantee. All the banks are get together, formulate a company in Sri Lanka. Okay. So normally we are not granting any facilities to these companies because there's no because the limitation of their the liability. Now, these people's companies are no more in the system, right? With the new 2007 Companies Act, people's companies have been demolished. But there are certain companies are still operating at Chilau, some fisheries boat, trawler boats companies, and also some companies at Kuliapitia. Some people's companies are there. The people's companies are more than 50 people get together and doing this. This Kuliapita project is exporting ginger, Chinese ginger, cultivating and exporting Chinese ginger at companies. Okay, right. What are the products in the commercial lending products? So we discussed earlier, there are three market segments: retail market, middle market, corporate market. Depending on the capital, depending on the volume of turnover, depending on the equity, capital, profit, and turnover, the segmentation has been created. There's no standard rule to say this segment is retail, this segment is middle market. As a back to back, their own criteria to identify. Retail market is the largest market where the traders are number of traders are there. Middle market is still higher. Corporate market is the very small market. Okay, so the commercial lending when you do these all three market together, basically we can identify two segments. One is domestic segment, other one is international segment. Domestic segment and international segment. Right, domestic segment we already discussed three types of lending products: fund-based products, asset-based products, and fee-based products. Okay, fund-based products are term loans, short-term loans, medium-term loans, long-term loans. Right. Now these term loans are we discussed earlier also. Term loans are given. Short, long-term loans are given for construction, right? Construction purposes and infrastructure development, warehousing, 5 to 10 years, those facilities. Comes under long-term facilities. Medium-term facilities are mostly for, again, capital investment for machinery, purchase of machinery, vehicles, furniture fittings, and equipments. That is for 3 to 5 years. Those are 3 to 5 years called medium-term loans. Then the short-term loans. Short-term loans, 1 year, 1 to 3 year, which is given for uh, normally uh, working capital finance. Okay, right. Fund-based products, this comes as the working capital loans. The operation side of the loan. Working capital loans, there are two types of facilities: permanent working capital or fixed working capital. Another one is revolving working capital or operating working capital. Permanent working capital are given to, to manage the debtors and the inventory of a business, where the debtors and inventory are revolving, but it's revolving, but it is blocked. So the capital is blocked in working capital called permanent working capital. Revolving working capital, day-to-day operating, right? Cost of goods sold, that is purchases, other expenses, right? Expenses like operating expenses, involved at establishment expenses, selling and distribution expenses, financial expenses. These are revolving facilities. It's operating, changing. Normally, we give revolving facilities up to 1 year. It can be a short-term revolving loan or a permanent overdraft facility product. So now, when you discuss these three, the term loans and the working capital finance, okay, you work out. Term loans and working capital loan, we work out. We find that we call this structuring of facilities. We call this as structuring of facilities. When you need-based finance, according to need, structure a facility for a customer, right? Then comes the asset-based products, the leasing and hire purchasing. So briefly, I tell what are these leasing and hire purchasing. The one is fee-based products are letters of guarantees, bank guarantees, letters of guarantee, or called as bank guarantees. Then comes the international trade, right? Commercial lending for international trade. There are two components. One is import trade, other one is export trade. Import trade also you got fund-based products and fee-based products. That's asset-based products in imports. Fund-based products are TR loans, trust receipt loans, hypothecation loan, and pledge loans. Trust receipt loans, hypothecation loans, pledge loans. And three types of loan facilities are available for imports, financing import trade. Then fee-based products are letters of credit, shipping guarantees, and duty guarantees. So I briefly tell what are these things. Letter of credit is an import trade to import some merchandise. The bank-to-bank arrangement is called letter of credit. Shipping guarantee is issued when the shipment is came and the documents are not arrived. To release the documents, shipping guarantees are issued. The duty guarantee, to release the goods from the customs, duty has to be paid, right? Where the merchandise is re-exporting, when you merchandise is re-exporting after manufacturing or re-exporting, the duty paid will be reimbursed. Okay. Therefore, normal customers without paying duty, getting a guarantee for the custom, the director of customs from the bank, we are promising that duty will be paid if not exported. If not exported. Okay. Other one is bank guarantees. Normal bank guarantee also given in import trade. Then comes export trade. There are two types of items you are getting: pre-shipment credit and post-shipment credit. Pre-shipment credit, post-shipment credit. Pre-shipment credit involves okay, the pre-shipment credit involves before shipment, the working capital finance to produce the merchandise or to collect the merchandise. Pre-shipment credit is given. So pre-shipment credit can be given as a trade close letter of credit or against the confirmed LC, right? Against the confirmed LC, certain percentage can be given as a loan. It's pre-shipment credit. Post-shipment credit, after the shipment is done, if there's a what do you call tenor bill means there's a credit facility given by the importer, exporter to importer, credit facility given as called uh, all these tenor bills are discounted. Right? Can be discounted. Right? Or bill purchase system can be discounted. So that's called a post-shipment credit. So these are types of credits available in our commercial lending platform. So what are the types of businesses that activities in commercial sector we are lending for? For trading, we are giving facilities, business expansion, working capital requirements, and check purchasing, short-term finance of check purchasing. The financing import, letters of credit, shipping guarantee, TR, hypothecation loans and overdrafts. The financing for export, pledge loans, packing credit loans, purchasing of export, bill and construction are the lending products, lending is what you call instrument for lending. Okay, what's a lease and what is leasing? Leasing is used without ownership. Leasing is to use without ownership. Without ownership. Leasing is a contract between lessor and lessee for hire of a specific asset. For a hire of a specific asset selected from the manufacturer or vendor of such asset by a lessee. Okay. Lessor retains ownership of the asset. Lessee has the possession and the use of the asset for an agreed period on payment of specified rentals. Now, what is leasing? This is one of the products we are having mostly misunderstood. Financiers as well as the customers, borrowers. Leasing is a contract between lessor and lessee. Lessor and lessee. That means Badukaru sa Baduhimiya. Lessor is the company giving the asset. Lessee is the person taking the asset on a rental for a hire of specific asset. Contract between lessor and lessee for hire of a specific asset. So therefore, leasing is a what? Hiring agreements. Leasing is a hiring agreement. Is a on a agreement to hire specific asset from the manufacturer or vendor that we selected person asset and lessee by the lessee. So therefore, ownership of the asset remains with the lessee, lessor. That's the company having the ownership. And the lessee has the possession, he is having the possession and use of asset for an agreed period on payment of specific interest. Therefore, leasing is not a credit facility, it's not a loan. It's leasing is not a loan. It is a rental agreement. Agreement between lessor and lessee to hire a specific asset. It's a rental agreement. No, it's not a loan. So most of these we have misunderstood leasing as a loan. The features of leasing, if you look at carefully, the conditions are different of a loan. If it's got a mortgage, the difference is procedure. Leasing is different procedure. Right. What is a lease? Lease is there basically if a person wants an asset, right? If a merchant or any, even for a consumer lending, you can use this leasing. And asset, for example, is a vehicle. So the lessee will select the vehicle for a company and tell the lessor that I want to buy this, I want this vehicle. So what will do? The lessor, that a lease company, will buy the asset, payment with payment, and giving on rental to the lessor to use. Thereby, ownership goes to the lessor. Lessor is the owner, right? The most important thing to understand here is after the agreement period, all the rentals are paid by the lessee, with the ownership will transfer to the lessor. Right? Ownership from lessor to lessee will it passes? No. Right? When the contract is over, for a rental agreement is over, the specific asset has to be returned back to the company. There's no automatic transfer. Now, this is what we have mostly misunderstood. But lessor and lessee can come to an agreement to buy that asset from the lessor after end of the period. Purchase that asset for a residual value or a nominal value. That's how the transaction goes on. On the face of it, you see that end of the period automatically ownership has transferred? No. It has to be, with a sales agreement only should go to the lessee. So in your document, when you look at your documents, right, when you prepare a document for the lease agreement, there is another one called buyback agreement is there. Lessee will agree to buy at a nominal value. So small amount, 1,500 or 2,000 at the specific, because already amortized the value, fully paid off the value of the asset plus the by the lessee by the way of a rental. Okay. So therefore, the ownership is with the lessor, and the lessor has to transfer the ownership by the way of a sales agreement to the lessee. Now, if you look at carefully, the Finance Lease Act specifically give this transaction. Okay, carefully understand that. Then, if the lessee defaulted the facility in between, even if one rental has to be paid, still for all, lessor has a right to repossess the asset. Okay, lessor has the right to repossess the asset. That is important thing you have to understand. If there are three similar product, lease, hire purchase, and mortgage. It is similar, but three different products, three different ways of handling. Right. There are two types of leases we are having. One is called financial lease. Financial lease is a contract involving payment over a certain period of specified sums, which in total liquidate the resource capital outlay and provide him with a profit. According to section 15, 15 of the Financial Lease Act, if you are taking a financial lease, it has to be fully amortized. That means entire amount has to be paid. So finance lease contract cannot be terminated in between. Cannot be terminated in between either party. It has to be liquidated totally. Totally, it has to be liquidated, paid full. That's why if a person want to settle a financial lease, the lessor asks to pay entire balance rentals. Even though he's not used the asset, he had to pay the rentals. They're going to liquidate. So it's a disadvantage. So it's called a finance lease. Finance lease is a contract. It has a certain asset to use for a period. End of the period, I told you earlier, it can be bought by the lessee for a specified amount or a residual value. Right? The other one is operating lease. An operating lease is that the asset is not wholly amortized during the opening period of the lease, and the lessor is relying on the renewal of the agreement at the end of the opening period, leasing the same equipment to a second lessee or selling the equipment at the or above an estimated residual value. Normally, operating lease mean for a short-term leases. Operating lease are these are mostly short-term leases. That means if a for example, contractor wanted certain heavy equipment, he can take an operating lease for shorter period. For example, for one period of 1 year. Okay, for 1 year period, he'll get it. Before expiry of 1 year, after 8 months or 9 months, and his job is over, he can return back the asset to the lessor, saying that I don't want this, to cancel that agreement. So he need to pay the rental thereafter. It's called operating lease. Operating lease normally uh, come to countrymen where buying or sometimes uh, agreement with the lessor to buy back. Right? So operating can do operating lease. There are some other types of leasing products are available. Those are also we have to know. Very commonly used is the buyback method. Buyback method. Now see, sometimes you may find there are certain companies advertising the lease. You come in your own vehicle, right? Leasing එක කරගෙන මුදලුයි වාහනේ මුදලුත් අරගෙන වාහනේ මාපොයි යන්න පුළුවන්. Now this is where the mostly misunderstood by the our customers as well as the bankers. What is the mode of operating? Now, for example, I'm buying a vehicle. Now, I want some money urgently. So I come to a company and want to say that I have to lease out this vehicle. Right? So the company what will do? First, purchase the vehicle from me on a sales agreement. Purchase the vehicle from me on a sales agreement, and after that, give me a lease on a rental with use. So I got the money for selling my asset. It is not a loan. Okay? Most of the people misunderstand this. It is not a loan. I sold my vehicle to the leasing company and got the money, sales proceed. Thereafter, same as a same vehicle, I am taking on a lease to use for 3 or 4 years to use and paying a rental. Right? So I will pay the rental, end of the rental period, I can pay back the loan. When I pay the full amount, the residual value I pay and get me a transfer the car vehicle in my name. So this is called buyback method, buyback agreement to purchase and purchase back. Okay, so company is selling at a residual value Y during the operating period. By the way of depreciation, total value has been amortized by the leasing company. Right. There are two more leasing types of leasing are there. It's not in, practically you are come across. One is called wet leasing, other one is dry leasing. Wet leasing and dry leasing. These two are normally used, mostly commonly used at aircraft hiring. Airplanes. In the, if you, for example, Sri Lankan Airlines want to get a plane, flight for a company, buying. So you can get as a lease. Dry lease mean without the crew and the staff. Without the staff, only the asset is taken. We use with our pilots, our crew will operate. It's called dry leasing. Wet leasing mean getting a lease. Operators are from their company. They are giving with the operating people who are operating the machinery or whatever it is by them. It's called a wet lease. In the war period time, we have got certain Russian planes were running from Jaffna Colombo domestic flights. Those were operated by Russians. Those are bought under wet lease. Well, in Sri Lanka, Sri Lankan Airlines got the flights on dry lease system. Okay, so it can be applied for machinery also. If you want to get a machinery or some for heavy machinery, operating for shorter period, operating lease with the dry or with the crew, it is wet leasing. Without operator, it's dry leasing. Okay, so two types of leasing products. Mainly financial lease are very commonly available in the Act, Sri Lanka Finance Lease Act number 56 of 2000, talking about finance lease, not about the operating lease. Okay, right. The next item is hire purchase finance. What is hire purchase finance? A system by which the buyer pays for an asset in regular installment while enjoying the use of it. During the repayment period, ownership of the item does not pass to the buyer. Upon the full payment of the loan, the title passes to the buyer. Now carefully read about these words, the hire purchase finance. Buyer. Buyer pays for an asset in regular installment while enjoying using it. During the repayment period, this not passed to the buyer. Upon the full payment of the loan, the title passes to the buyer. Hey, madam, what is hire purchase? Hmm? That is hire purchase. It's a loan. Lease is not a loan, it's a rental agreement. Hire purchase is a loan. Right? Hire purchase, if I clearly define it, what is hire purchase is a deferred sales agreement. Hire purchase a deferred sales agreement. You buy a product and you pay to the product in later date, deferred installment basis some other day, not immediately, before payment. That's called hire purchase. There are some similarities with the hire purchase and the lease finance, right? So hire purchase also had to pay the loan installment. Where the lease agreement we pay the rental, hire purchase there's no rental, it is loan installment. Okay, so loan installment has to be paid. So that involved in hire purchase finance. And after full settlement, right? After full settlement, automatically ownership will transfer to the hire purchasee. Lease එක ඒව වෙන්නේ නැහැ. ඔය දේ තමයි පටලවා ගන්න අපි. Okay. In the hire purchase, automatically ownership will be transferred because so it's a agreement, deferred sales agreement. Already sales agreement is there, right? Governed under sale of goods ordinance, governs the sale of goods ordinance. There's a sales agreement to pay a later date. It's a credit purchase, in other words. Okay. Right. But there are certain legal sections also to it. There's a act called Consumer Credit Act 29 of 2000. Under that, there are certain uh, benefits are given to the hire purchasers, which is not there in leasing. According to the Consumer Credit Act, if the hire purchasee paid 75% of the value over the period, 75% of the value of the asset has been paid already, that even though after that, if he defaulted, the company, the hire purchaser, does not have the right to repossess the asset. Hire purchaser asset repossess කරන්න බෑ 75% වුණා අදින් ගෙවලා තියෙනවා under Consumer Credit Act එකේ. So protection given to the consumer. So in such instances, the hire purchase, the company has to, finance company has to file action to recover the balance. But the ownership will be remaining with the company which is not transferring. Although you cannot repossess, ownership will be there till the last cent is paid. After that, it automatically transfers. Okay, so these are two products very commonly used. Different types, other different types I discussed because we should understand what are these products. Okay, right. Then comes to the fee-based product. The commonly used fee-based product is letters of guarantee or letters bank guarantee. What's a bank guarantee? What's a bank guarantee? Bank guarantee is a contract of guarantee. It's a contract to perform the promise or discharge the liability of a third person in the case of his default. Contract guarantee is a contract to perform the promise or discharge the liability of a third person in case of his default. Right. It's a contract between a person, say A, with the bank, right? That to fulfill certain liabilities to a beneficiary, if that liability is not discharged, defaulted, any damages bank will pay to the beneficiary. It's called a guarantee. Right? Guarantees the customers, there are two types of guarantees. One is financial guarantee, other one is service guarantee. What is financial guarantee? guarantees the customer's applicant financial wealth, creditworthiness, and his capacity to take up financial risks. Very common one is credit purchases. We'll take an example and try to find out, analyze what is this. What is a financial guarantee? Very commonly used is financial guarantees. Now, we say a business, Chandra stores. So Chandra stores wanted to purchase anchor products of Frontier Limited, right? Frontier, they want to buy anchor products. One say being wholesale rate, wholesale business, right? Frontier is agreed to give product up to worth of 1 million on credit basis. Frontier Limited agreed to give 1 million worth of products on credit basis to Chandra stores. Normally, in evaluating such a credit, certain of a what you call a collateral or security should be kept in. So Frontier will request Chandra stores to produce a bank guarantee regarding your financial wealth, creditworthiness, and take up the financial risk, a guarantee from the bank. So Chandra stores comes to a bank, ask for a bank guarantee, right? So issue a bank guarantee, requesting to issue a bank guarantee to the Frontier Limited. So the contract or the agreement between bank and the Frontier Limited, or the agreement guaranteeing give the credit to this person if he stores, Chandra stores. If he defaults, I will pay. He will pay. We will take the responsibility without any what do you call there are certain conditions are there. With that conditions, we will pay without any onerous clause. Okay, so within 1 million limit, this person Chandra stores can do his transaction up to that amount. If Chandra stores defaulted, Chandra store defaulted that facility, that means not paid to Frontier Limited, the credit facility, the Frontier will send a letter of demand to the bank, asked to pay that amount. That's, that's called a financial guarantee, which is applies. Second one is performance guarantee. Performance guarantee is to guarantee obligations related to the technical, managerial, administration experience and the capacity of the customer applicant. Performance guarantee is little different. That is, we are guaranteeing not the financial stability of the applicant. It is the professional or performance, the technical knowledge or managerial knowledge or capability of doing that performance job. It's called performance. There are two types of performance guarantees. One is service guarantee, other one is tender guarantee. One is service guarantee, other one is tender guarantee. Service guarantee means to provide certain services, a guarantee is required. For example, the government organization issue licenses, right? License for bar licenses, issuing for entertainment licenses, transportation of metal and earth, other things. Then Foreign Employment Bureau, conducting a foreign employment agency. Now, to get a license, right, certain amount of money has to be lodged in that organization. Instead of blocking the funds, a customer can get a bank guarantee, performance guarantee, and given to that organization, right, to cover up that cost. Normally, performance guarantee are less risk because no, what you call, applicant will try to default that, because if he defaulted, he will be blacklisted. He won't get that job thereafter. Unlike finance guarantee. Therefore, mostly for performance guarantees are lesser riskier. Okay. The other one is tender guarantees. Tender guarantees, there are four types of tender guarantees are there. Bid bond guarantee, advance bond guarantee, performance bond guarantee, retention bond guarantee. We'll take an example. Now, our IBSL want to put up a building, right? Right? IBSL want to put up a building. So, value of the building is, we say, 50 million rupees. Trillion rupees worth of building has to be. So the IBSL have designed the, got the, what do you call, plan and everything approved, got it approved, and the CEO, what do you call, the approved, necessary approve everything. Then they call constructors to do the construction. So different contractors, they make a bid, ask a bid. So to the bid, normally had to deposit certain amount. To bid, certain amount has to be deposited in the IBSL to make the bid. So sometimes about large sum. Now, without depositing this money, it will affect their cash flow. No? So a bank guarantee can be given. So that when the IBSL wanted to anybody bid, that non-refundable charges will be non-refundable charges separate, refundable charges. So refundable charges can be given as a bank guarantee. So the bank will give as a called bid bond guarantee. Bid bond guarantee is normally for 3 months period maximum given because it will be the bond will be open within 2 3 days. When the tender will open 2 3 days, and after that bond will be no more needed. Then IBSL will select one contractor to do the contract. For example, say Maga Institute. So Maga has selected to do the construction. So tender is awarded to Maga. Before signing the agreement between to start the performance, the company may ask, that is IBSL may ask, your guarantee that you can do this. Maga have necessary equipment, necessary manpower, necessary capital, everything is available. Your guarantee, technical, manager, administration experience, and the capacity on the bank guarantee. So bank will issue a guarantee for that. That's called performance guarantee. Bid bond guarantee, performance guarantee. Once a agreement is signed to start up the business, to start up the construction, Maga wants a certain amount of a initial, what you call advance. So that also, so once the performance bond issued, the tender bond will be cancelled. That is, bid bond will be cancelled and go for the performance bond. Once a performance bond is issued, then ask for another bond that will get an advance, cash advance. That's called advance payment bond. Issue advance. So the advance payment bond will be revolving. Right? It will be revolving continuously is going on. After the construction is over, the building is going to be handed over. Once you hand over, the full amount balance has to be paid to the Maga Institute, Maga, what you call contractors. But normally, after any tender, a certain amount will be retained, 10% and only 10% will be retained. For what purpose? If any shortcoming or any deficiency in the contractor is bound to do it back. Do it. For example, certain construction put certain areas has water leak, certain areas, certain things are not performing, not functioning well. So for that, the contractor has to come and redo the thing. That cost has to be borne by the contractor. But if the contractor fails to do that, then the institute can employ somebody else and get it done. For that, he have retaining that one amount. It's called retention bond. So retention of the final payment. It's called retention bond. Usually retention bond, performance bond will be cancelled. So this is a procedure of guarantee, tender guarantee and service guarantees are what are types of guarantees available. So before we find certain important factors to be talked about this guarantee, the guarantees. The normally guarantees are issued for maximum of period of 12 months. Okay, normally maximum a period of 12 months, and it will be renewed before the expiry. It has to be renewed. When it comes to foreign exchange bureau, the normally can issue for 2 years, right? Normally, so 1 year, more than 1 year we can't give. This is 2 years for is accepted at SLEB, that's Foreign Employment Bureau. Secondly, there's no certain conditions are there. There's no automatical renewal condition. There's no automatical renewal condition in the agreement, the guarantees. So any letter of guarantee before the expiry, it has to be extended. So that means before the expiry, 1 month before, the bank has to issue a letter to the beneficiary that whether we are willing to extend this one, and to the customer also whether we willing to extend this, right? This will extend the guarantee. If so, we can renew for another further period of 1 month or 1 year. There's no clause called automatical renewal. It has to be renewed annually with the consent of the parties. With the consent of the parties. Okay. Then next one is whenever if any default of a guarantee, right? The amount claimed by the beneficiary, bank is liable to pay. Bank is liable to pay that without any hesitation. Without any contract between the parties, bank is not liable for that contract, that agreement. For example, I give a case what happened. There was a case where customer had made what you call letter of guarantee to purchase dainty toffee from Dali Butler. Dali Butler to purchase dainty toffee. The letter of guarantee value was 50,000 rupees. Okay. And the sales rep comes and delivers. The customer pays to the sales rep the check. Payment is paid to the sales rep. The sales rep has not given the checks to the Dali Butler, and he has taken in the money from the check, deposited his account, and got the money. So according to Dali Butler, this customer has been defaulted. customer has defaulted. So Dalip has sent a letter of demand to this customer to pay 50,000 rupees as agreed in the letter of guarantee. When this demand came to the bank to pay, it comes directly to the bank has to pay this. Immediately you have to pay. There's no any, we cannot delay any claim. When a claim comes, we have to pay. But he's a good customer of ours. So I spoke to the customer and told the asset of demand has come from the Taliban claim. Whether I have to pay, if not paying, I'll give only 1 day. Within tomorrow, if you have to tell me what I have to do, otherwise we have to pay this according to the agreement between the on the performance guarantee. So he came, rushed and told the customer to the bank that the amount due is to the Dali Butlers only 12,000 rupees, not 50,000 rupees. Don't pay that. Now, what is the position of the bank? Hmm? What is the position of the bank? Can we stop that claim without paying, hold it? No, we can't. So I gave only 1 day and asked either there are two things can be done. Either we have to pay it or customer has to take a stay order, injunction order against the bank not to pay. Then we can stop it. But this customer went to the Dali Butler and they negotiated that and settled it. So legally, if there's an injunction order, till the court decides, we had to stop any claim. We can't pay. We are not going to pay till the court decided. So what the People's Bank did in this Chinese fertilizer case, there was a court case. Till the court decides, he said he can't pay. Although demand has been made, we can't pay because there's a court case is going on. Till the court case is over, now we can't pay. So the other parties are intervening in the settlement anyway. So therefore, where injunction order or court order has come, we have to suspend till the case is over. We are not liable to pay. Okay. During this time, you may find that performance guarantee may get expired. Guarantee may expire. So the guarantee expired, even guarantee expired, the guarantee will extended till the case is over, but no any claim on it. No any other claim on it. Either it can be extended, after that will be the same thing. So these are the factors practically how is the performance guarantee, the guarantees are used and practical cases come to, we have to very tactfully handle it. Okay, if you pay that, we owe payment, let them, we can pay. Because legally, we had to pay that amount, 50,000 rupees. Let the customer and their beneficiary solve it in the courts. It's not RBS. Right? So we may lose the customer. Both sides. So we have to balance both sides and work it in this type of situation. Well, so that's all about the case what I will discuss about the guidance and type of products, lending products. So we discussed what are the guidelines, or where the guidelines are concerned, the central bank guidelines, and also internal guidelines, and what are the guidelines, and also types of lending products, what are the products available, what are the features of the products we discussed. Okay, so for the initial basic, what are basics is you should know what we discussed. Thank you very much. So any questions?